Legal. The following content regarding foreign exchange Forex trading is strictly for educational and entertainment purposes only. It does not constitute financial, investment, tax, or legal advice. Foreign exchange trading carries a high level of risk and may not be suitable for all investors. Leverage can work against you as well as for you. Before deciding to trade foreign exchange, you should carefully consider your investment objectives, level of experience, and risk appetite. The possibility exists that you could sustain a loss of some or all of your initial investment, and therefore you should not invest money that you cannot afford to lose. You should be aware of all the risks associated with foreign exchange trading, and seek advice from an independent financial advisor if you have any doubts. Past performance is not indicative of future results. The creator of this content assumes no responsibility for any losses or damages resulting from the use of the information contained herein. Conduct your own due diligence. $7.5 trillion. That is the amount of money that changes hands in the foreign exchange market every single day. To put that into perspective, the New York Stock Exchange, the largest equities market in the world, trades about $200 billion a day. The Forex market is not just bigger, it is an ocean compared to a swimming pool. It is the largest, most liquid financial market on the planet. And yet, statistics from major regulatory bodies and brokerage firms consistently suggest that between 70 and 90% of retail traders, people exactly like you, lose money in the long run. Most wipe out their entire account within the first 90 days. This stark contrast creates the ultimate paradox of the financial world. How can a market so flush with liquidity, so open to participation, and so fundamental to the global economy be the graveyard for so many financial ambitions? The answer is not that the market is rigged, though it is certainly ruthless. The answer is that the vast majority of participants enter this arena with the mindset of a gambler, rather than the strategic framework of a risk manager. They look at a chart and see a slot machine. They do not see the geopolitical and macroeconomic battleground that is actually playing out in front of their eyes. You are here because you want to be part of the minority. You want to understand how to navigate the currents of the global economy, rather than drowning in them. This is not a 10-minute overview or a quick fix tutorial. This is part 1 of a comprehensive, 10-part deep dive masterclass on Forex trading. We are going to strip away the noise, the marketing hype, and the complex jargon to rebuild your understanding of currency trading from the ground up. The promise of this series is simple but profound. We will move you from a state of unconscious incompetence, where you do not even know what you do not know, to a place of conscious competence. By the end of this masterclass, you will not just be looking at red and green candlesticks. You will be reading the sentiment of nations. You will understand why a central bank interest rate decision in Australia impacts your portfolio in the United States. You will understand that you are not predicting the future. You are managing probabilities. Let us begin by deconstructing the beast itself. What exactly is Forex? At its core, Forex is the mechanism by which individuals, companies, and central banks convert one currency into another. While that sounds dry, it is the lifeblood of global commerce. If you live in the United States and you want to buy cheese from France, either you or the company that you buy the cheese from has to pay the French strictly in euros. This means the US dollar, the greenback, must be sold and the euro must be bought. This transaction happens billions of times a day for everything from oil and gold to cars and software services. Most beginners have already participated in the Forex market without realizing it. If you have ever traveled internationally, say from New York to London, you likely exchanged your dollars for pounds at the airport kiosk. You looked at a screen that said the exchange rate was 1.25. You handed over $500 and you received 400 pounds in return. You just executed a Forex trade. You sold USD and you bought GBP. Now here is where the concept of speculation, the focus of this masterclass, comes into play. Imagine you arrive in London but you never spend a single pound. You keep that cash in your wallet. While you are enjoying the sights, major economic news breaks. Perhaps the US economy shows signs of weakness, or the Bank of England raises interest rates. These macroeconomic shifts cause the value of the pound to rise relative to the dollar. When you fly back to New York a week later, you go to the booth to exchange your 400 pounds back into dollars. But now the rate isn't 1.25. It is 1.35. When you hand over your 400 pounds, the clerk hands you back $540. You still have the original principal, but you have made a $40 profit simply because the relative value of the two currencies changed while you were holding the asset. This is the essence of Forex trading. We are looking for these fluctuations. However, we do not fly to London to do it. We do it digitally, instantly, and with a tool called leverage, which allows us to control large positions with a relatively small amount of capital. But that example, while simple, hides the complexity and the danger. In the airport example, you used your own cash. In the professional trading environment, you are often trading on margin, which means you are borrowing capital to amplify your exposure. This amplification is why Forex is so attractive to beginners with small accounts, but it is also exactly why the failure rate is so high. If that exchange rate had gone the other way, and you were highly leveraged, you wouldn't just lose $40, you could lose your entire deposit in moments. The primary reason new traders fail is a fundamental misunderstanding of who they are up against. This is not a game of you versus the chart. This is a zero-sum environment in the short term. For you to buy, someone must sell. For you to make a profit, someone else or some other entity must take a loss or have a different objective. In the stock market, you might be buying shares of a company like Apple because you believe in the iPhone. If Apple does well, everyone who owns the stock wins. The stock market can be a positive-sum game during a bull run. Forex is different. Currencies are traded in pairs. You are always long one currency and short another. It is a relative valuation game. You are a minnow swimming in an ocean dominated by whales. The market participants are tiered. At the top, you have the superbanks, the Tier 1 liquidity providers like JP Morgan, Deutsche Bank, Citi, and UBS. These institutions transact 53% of all Forex volume. They are not guessing where the price is going. In many ways, their flow is the price. Below them, you have large commercial companies hedging their business risk, like Toyota protecting itself against a drop in the yen. Then you have the central banks, who intervene to stabilize their national economies. Then, at the very bottom of the food chain, there is the retail trader. That is you. You do not have the power to move the market. You cannot fight the trend created by the institutions. Your only job and the sole focus of this course is to identify the footprints of these giant participants and hitch a ride on their momentum. We are not trying to beat the bank. We are trying to swim in their wake. Over the next 9 parts of this series, we are going to systematically dismantle the confusion surrounding this industry. We will move away from the get-rich-quick mentality that plagues YouTube comments and Instagram feeds. We are going to treat this like a business. In Part 2, we will tackle the jargon. We will define pips, lots, spread, and margin, not just as textbook definitions, but as mathematical components of your survival. You cannot play the game if you do not speak the language. In Part 3 and 4, we will dive into fundamental analysis. This is the why of the market. Why does the US dollar move when unemployment numbers are released? Why does the Japanese yen react to bond yields? We will teach you how to read an economic calendar, so you are never blindsided by a volatility spike. Then we will move to technical analysis. This is the win. We will look at market structure, support and resistance, and price action. We will debunk the myth of magic indicators and show you how to read raw price data. But perhaps most importantly, we will spend a significant amount of time on risk management and trading psychology. This is the how. How do you size a position so that a string of 5 losses doesn't bankrupt you? How do you handle the emotional psychological warfare of winning and losing money in real time? The journey you are about to embark on is difficult. If anyone told you Forex is easy money, they lied to you. It is a profession that requires the discipline of a soldier and the patience of a monk. The market does not care about your rent money, your dreams, or your ego. It is a cold, efficient mechanism of price discovery. However, for those who are willing to respect the risk, learn the mechanics, and master their own psychology, it offers liquidity and opportunity unmatched by any other asset class. You can trade 24 hours a day, 5 days a week. You can profit when economies are booming and profit when they are crashing, because you can sell a currency just as easily as you can buy it. This is Forex trading for dummies, but by the end of this series, you will be far from a dummy. You will be an informed, risk-aware market participant. So close your other tabs, put your phone on silent, and prepare to take notes. The education begins now. Let's get to work. Imagine walking into a cockpit of a fighter jet. You see hundreds of buttons, flashing lights, and dials spinning wildly. You know this machine is capable of breaking the sound barrier, but if you do not know what the altimeter reads or what the throttle controls, you will not just fail to fly, you will crash before you even leave the runway. In the world of Forex, the jargon the specific language traders speak is that cockpit. If you cannot speak the language fluently, the market will eat you alive. The first concept you must master is the currency pair itself. In the stock market, you buy a share of Amazon. You exchange cash for a piece of the company. Simple. In Forex, you are never just buying something. You are simultaneously buying one currency and selling another. It is a tug of war. Think of every single currency pair as a fraction. Let's look at the most traded pair in the world. The euro to US dollar. The euro against the US dollar. The currency on the left, the euro, is called the base currency. The currency on the right, the dollar, is the quote currency. Here is the golden rule. The base currency is the one you are transacting. The quote currency is the money you are using to pay for it. If you see the euro to US dollar price on your screen at 1.0500, that tells you exactly one story. It takes $1.05 to purchase one single euro. Now, imagine if news breaks that the US economy is crashing. The dollar gets weaker. In our tug-of-war analogy, the dollar team is slipping in the mud. The euro team pulls the rope harder. What happens to the price on your chart? It goes up. Not because the euro got stronger, but because the dollar got weaker. It now takes more weak dollars to buy that same sturdy euro. This relative valuation is critical. You must stop thinking of money as having a fixed value. Value is relative. But traders do not talk in cents or dollars. We talk in pips. This is the heartbeat of the market. PIP stands for percentage in point, or price interest point. For most currency pairs, the pip is the fourth decimal place. Let's do the math. If the euro to US dollar moves from 1.1000 to 1.1001, that is a 1 pip move. It looks microscopic, doesn't it? A fraction of a penny. You might be asking yourself, why am I wasting my time trying to catch a movement of 1/100th of a cent? This brings us to the concept of lots and leverage, the dynamic duo that creates both millionaires and bankruptcies. Because a 1 pip move is so tiny, you need to trade massive amounts of currency to make it worth your while. We trade in lots. A standard lot is 100,000 units of the base currency. If you are trading a standard lot of euro to US dollar, you are effectively buying 100,000 euros. Here is the math of the potential profit. If you are trading a standard lot, a single pip movement, that tiny fourth decimal shift, is worth $10. Now the game changes. If the market moves 50 pips in a day, which is a very standard daily range, and you are holding a standard lot, you have made $500. But wait, do you have 100,000 euros sitting in your bank account to put up for this trade? Most retail traders do not. This is where your broker steps in with leverage. Leverage is a loan. It is your broker saying, I trust you to manage this massive position, provided you put down a security deposit. This deposit is called margin. Let's say your broker offers you 1-to-100 leverage. This means for every dollar you have in your account, you can control $100 of currency. To control that $100,000 standard lot, you do not need $100,000. You only need $1,000 of your own money as margin. The broker lends you the rest. This sounds fantastic, right? You put down 1,000, you control 100,000, and you make $500 in a few hours. That is a 50% return on your margin in one day. This is the dream they sell you in the advertisements. Now let's look at the nightmare. This is the scenario that wipes out 90% of beginners. Imagine you open that same trade. You put up your $1,000 to control a standard lot. You buy, expecting the price to go up. But the European Central Bank releases a statement saying inflation is down. The euro drops like a stone. The price moves against you. Not by much, just 50 pips. Remember, on a standard lot, 50 pips equals $500. But this time it is minus $500. You haven't lost $500 of the broker's money. You have lost $500 of your margin. Your $1,000 deposit is now worth $500. You have lost 50% of your account in a single move. If the market drops another 50 pips, your account hits zero. This is called a margin call. The broker will automatically close your trade to protect their capital. They will not let you lose their money. They will only let you lose yours. The moment your equity drops below the required margin, you are liquidated. Game over. This is why position sizing is the first line of defense. You do not have to trade standard lots. You can trade mini lots, 10,000 units, where a pip is worth $1, or micro lots, 1,000 units, where a pip is worth 10 cents. If you are a beginner with a $500 account, and you try to trade a standard lot, you are statistically guaranteed to blow up your account. A mere 5 pip move against you, which can happen in 1 second, would wipe out 10% of your account. You are driving that fighter jet at maximum speed directly into a mountain. We also have to discuss the cost of doing business, the spread. Have you ever noticed that when you go to a currency exchange booth, the price to buy and the price to sell are different? That gap is the spread. It is how the broker keeps the lights on. In your trading terminal, you will see a bid price and an ask price. The bid is the highest price the market will pay you for your currency. The ask is the lowest price the market will sell it to you. The ask is always higher than the bid. This means the very second you click buy, you are instantly in a loss. You enter the trade at the higher ask price, but if you wanted to close it immediately, you would have to sell at the lower bid price. You start every race a few steps behind the starting line. You have to overcome the spread before you can even see a penny of profit. If you are trading a pair like the euro to US dollar, the spread might be tight, maybe 1 or 2 pips. But if you decide to trade something more exotic like the US dollar against the Mexican peso, the spread could be 50 pips. You would need a massive move just to break even. This is why beginners should stick to the majors, the most liquid pairs with the lowest spreads. Euro to US dollar, pound sterling to US dollar to Japanese yen. Let's recap the toolkit you have built so far. You understand that you are trading pairs, playing a game of relative strength. You know that pips measure the distance, lots measure the volume, and leverage acts as a multiplier that can either supercharge your gains or incinerate your capital. You know that the spread is your cost of entry, but looking at a chart and knowing what a pip is doesn't tell you where the price is going. Knowing how to drive the car doesn't help if you don't have a map. Right now you are staring at a chart, and the price is moving up and down. But why? What invisible hand is pushing the graph? Is it a tweet from a president? A shortage of oil in the Middle East? Or perhaps an unemployment report released in Washington, D.C.? The charts are just the shadow of something much larger. To predict the shadow, you must understand the object casting it. In Part 3, we are going to leave the charts behind and step into the war rooms of global finance. We are going to dive into fundamental analysis. We will uncover exactly how interest rates, inflation, and GDP reports dictate the flow of trillions of dollars, and how you can spot a market tsunami days before it hits the shore. You have the controls, now you need the map. Don't go anywhere. Welcome to the engine room. If technical analysis, looking at charts and patterns, is the art of driving the car, fundamental analysis is the understanding of the engine, the fuel, and the terrain. You can be the best driver in the world, perfecting your turns and managing your speed, but if the engine explodes or you run out of fuel, you are not going anywhere. Many retail traders skip this step. They find it boring. They want to draw lines on a chart and feel like a sniper. But the institutional whales, the ones moving the market, do not make billion-dollar decisions because a line on a chart crossed another line. They move money based on the economic health of nations. Fundamental analysis is the study of why price moves. In the Forex market, this boils down to one simple universal truth. Capital flows to where it is treated best. Imagine you are a global hedge fund manager managing $10 billion. You are not going to leave that money sitting in a currency that is losing value or paying you zero interest. You are going to move that massive capital into a currency that offers you a return on investment and safety. This movement of capital is dictated by 3 major pillars: interest rates, inflation, and economic growth. Let's start with the king of Forex. Interest rates. Giddy images. If you remember nothing else from this entire series, remember this. The currency with the higher interest rate, or the expectation of a higher interest rate, tends to strengthen. Here is why. Imagine 2 banks. Bank A offers you 1% interest on your savings. Bank B offers you 5%. Where do you put your money? You put it in Bank B. It is a no-brainer. Now apply this to countries. If the Federal Reserve in the United States sets interest rates at 5%, and the Bank of Japan sets interest rates at 0%, global investors will sell their Japanese yen and buy US dollars to park their cash in US bonds and assets that yield that 5% return. This selling of yen drives the yen down, and the buying of dollars drives the dollar up. This creates a phenomenon known as the carry trade. This is not just a theory. It is one of the primary strategies used by investment banks. They borrow money in a currency with a low interest rate like the yen historically, and they use that borrowed money to buy a currency with a high interest rate. They profit from the difference. When millions of traders and algorithms do this simultaneously, it creates massive long-term trends that can last for years. You cannot fight these trends with a simple chart pattern. But who decides these rates? The central banks. In the US, it is the Federal Reserve. In Europe, the ECB. In the UK, the Bank of England. These institutions meet roughly once a month to decide the cost of money. As a Forex trader, these meeting dates are your Super Bowl. When the Federal Reserve Chairman walks up to the podium, the markets hold their breath. If he sounds hawkish, meaning he wants to raise rates to fight inflation, the dollar often spikes instantly. If he sounds dovish, meaning he wants to lower rates to stimulate the economy, the dollar often drops. This brings us to the second pillar, inflation. You know inflation as the reason your groceries cost more this year than they did last year. It is the erosion of purchasing power. Logically, you might think high inflation is bad for a currency. If the money buys less, it should be worth less, right? In the long term, yes. But in the short-term world of Forex trading, the reaction is often the opposite. This is where beginners get trapped. Let's say the United States releases a consumer price index, CPI report showing that inflation is rising rapidly. A novice trader might sell the dollar thinking, inflation is bad, the dollar is weak. But the professional trader buys the dollar. Why? Because the professional knows how the central bank thinks. The central bank's job is to control inflation. If inflation is hot, the central bank is forced to raise interest rates to cool it down. And as we just learned, higher interest rates attract global capital. So paradoxically, a report showing high inflation often causes the currency to skyrocket in value immediately, because the market is pricing in a future rate hike. This is why you need to understand the narrative, not just the numbers. You are trading the market's expectation of the future, not just the present reality. The third pillar is economic growth, often measured by GDP, gross domestic product, and crucially, employment data. A strong economy creates jobs. People with jobs spend money. Companies make profits. This attracts foreign investors who want to buy stocks and real estate in that country. To buy those assets, they need that country's currency. The most important data release in the entire Forex calendar is the non-farm payrolls, or NFP. It is released by the U.S. Bureau of Labor Statistics on the first Friday of every month. It tells us how many jobs the U.S. economy added or lost, excluding the farming industry. The volatility during the NFP release is legendary. In the span of 1 minute, a currency pair like euro to US dollar can move 100 pips. That is the kind of move that usually takes a week. Fortunes are made and lost in those 60 seconds. Imagine this scenario. It is Friday morning, 8:30 a.m. New York time. The forecast expects the US to have added 150,000 jobs. You are sitting at your terminal. The report comes out. The US actually added 300,000 jobs. A massive beat. The algorithm reacts instantly. A strong labor market means a booming economy. A booming economy means the Federal Reserve might keep interest rates higher for longer to prevent overheating. The result? A massive green candle on the US dollar charts. If you were betting against the dollar at that moment without knowing the news was coming, your stop loss would be hit before you could even blink. This leads us to the practical application of fundamental analysis. The economic calendar. You cannot trade Forex without one. Every morning, before you look at a chart, you must look at the calendar. It lists every major data release scheduled for the day: CPI, GDP, retail sales, central bank speeches, and rates them by importance. High-impact events are usually marked in red. Your rule as a beginner is simple. Do not trade blindly through a red folder event. The volatility is essentially a coin toss. If you have an open trade and a major speech from the Fed chairman is coming up in 10 minutes, the prudent professional move is often to close the trade or tighten your risk. You do not gamble on the news, you manage the risk around it. Fundamental analysis gives you the bias. It tells you whether you should be looking to buy or sell. If the US economy is strong, rates are rising, and inflation is hot, your fundamental bias is long dollar. You want to buy the dollar, but knowing what to buy is only half the battle. You could be absolutely right that the dollar is going up, but if you buy it at the wrong moment, right at the top of a peak, you will still lose money as the market retraces. You have the engine fundamentals that powers the move. Now you need the steering wheel to time your entry. You need to know exactly which price level to enter, where to put your safety net, and where to take your profit. This is where technical analysis comes in. It is the study of price psychology, visual patterns, and market structure. In Part 4, we are going to open the charts. We are going to strip away the confusing indicators and show you how to read the raw language of price itself, the candlestick. Most people think they know how to read a candlestick chart, but they are reading it like a child reads a picture book. We are going to teach you to read it like a forensic scientist. You will learn to spot the exact moment the buyers take control from the sellers. The chart is about to speak to you. When you look at a standard line chart, the kind you see on the news or in basic finance apps, you are seeing a lie. Or, at the very least, you are seeing a heavily redacted version of the truth. A line chart connects the closing prices of a set time period. It tells you where the price ended up, but it completely hides the violence, the struggle, and the emotion of how it got there. To trade Forex effectively, we need to see the struggle. We need the Japanese candlestick. Shutterstock. This method of charting was developed in 18th century Japan by a rice trader named Munehisa Homa. He realized that while the price of rice was determined by supply and demand, the markets were also heavily influenced by the emotions of traders. He created a visual system to represent that emotion. Today, it is the standard for professional trading. Let's dissect the anatomy of a single candle. A candlestick gives you 4 pieces of data for a specific time period: the open, the high, the low, and the close. The thick part of the candle is called the body. This represents the distance between where the price opened and where it closed. If the close is higher than the open, the body is usually green or white. This is a bullish candle. It means the buyers won the round. If the close is lower than the open, the body is red or black. This is a bearish candle. The sellers won. But the most critical part of the candle is often not the body. It is the thin line sticking out of the top and bottom. These are called the wicks or shadows, and they are the footprints of rejection. Let's play out a scenario to understand why this matters. Imagine we are looking at a 1-hour candle for the euro to US dollar. At 1 p.m., the candle opens at 1.1000. Immediately, bad news hits or a large sell order comes in. The price collapses. It drops all the way down to 1.0950 within the first 20 minutes. At this moment, if you were watching the chart live, that candle would look like a solid, terrifying red bar. It looks like the market is crashing. But then, at 1.0950, something happens. The institutional buyers, the whales we talked about earlier, decide that 1.0950 is a discount. They step in with massive buy orders. The price stops falling. Then it starts to climb back up. It climbs all the way back to 1.1000, erasing the loss. But the buyers aren't done. They push it higher, up to 1.1010. At 1:59 p.m. and 59 seconds, the clock runs out. The candle closes at 1.1010. What is left on the chart? You have a small green body at the top and a very long wick sticking out the bottom. This shape has a name. It is called a pin bar or a hammer. But forget the name for a second and focus on the story. That long lower wick tells you a secret. It tells you that the sellers tried to push the price down, they gave it everything they had, and they failed. They were overwhelmed by buyers. When you see a long wick pointing down, it is a visual scream that says, the market rejects these lower prices. Conversely, a long wick pointing up, a shooting star, tells you the market tried to go higher and got slapped back down. This is how you read sentiment. You are looking for who is exhausted and who is in control. There are 3 primary patterns you need to memorize, as they appear constantly on price charts. First is the engulfing pattern. This is a 2-candle formation. Imagine a small green candle, followed immediately by a massive red candle that is so large its body completely covers or engulfs the previous green one. This is a violent shift in momentum. It is like one army capturing a small hill, and the opposing army responding by dropping a nuclear bomb. When you see a bearish engulfing pattern, it indicates that the sellers have aggressively taken control. The probability of the next move being down is high. Second is the doji. This is a candle where the open and the close are almost exactly the same price. The candle looks like a cross or a plus sign. It has almost no body. A doji represents indecision. It is a standoff. The buyers pushed up, the sellers pushed down. But when the bell rang, nobody had gained an inch. When you see a doji after a long trend, for example, if the price has been rocketing up for days and then suddenly prints a doji, it is a warning sign. The momentum is dying. The buyers are tired. A reversal might be coming. Shutterstock. Explore. However, and this is a massive however, a candlestick pattern by itself is not a strategy. This is where the dummies get separated from the pros. If you see a bullish pin bar, that hammer we talked about, should you buy? Not necessarily. A hammer in the middle of nowhere means nothing. A hammer at a key support level means everything. Context is king. You have to know where the battle is taking place. If you see a reversal candle but it forms right in the middle of a strong downtrend, it is likely a trap. But if that same candle forms at a price level that has historically bounced before, now you have a trade. This brings us to the concept of time frames. Forex charts are fractal. This means the patterns repeat on every scale, from the 1-minute chart to the 1-month chart. Most trading platforms allow you to switch timeframes instantly. If you look at the D1 or daily chart, each candle represents one full day of trading. If you look at the H1 or hourly chart, each candle is 1 hour. Here is the math. One daily candle contains 24 hourly candles. Inside that one daily candle that looks like a simple green bar, there might be a massive war on the hourly charts with trends, reversals, and panic. New traders often ask, what is the best time frame to trade? The answer depends on your personality, but here is the rule of thumb. The higher the time frame, the more reliable the signal. A pin bar on a 5-minute chart might just be a random noise caused by a single bank transaction. It means very little. A pin bar on a weekly chart is a statement by the entire global economy. It means the sentiment of the world has shifted. However, trading on weekly charts requires massive patience and larger stop losses. Trading on 5-minute charts requires intense focus and speed. Most retail traders settle somewhere in the middle, the 1-hour or 4-hour charts, where they can filter out the noise but still find frequent opportunities. So let's take stock. You know that the chart is a battlefield. You know that the body shows the result and the wick shows the struggle. You know that a hammer means rejection, and an engulfing candle means domination. But right now, you are looking at individual trees. You are analyzing one candle at a time. To navigate the forest, you need to zoom out. You need to connect these candles to see the bigger picture. Is the market generally moving up? Is it moving down? Or is it moving sideways? The old saying is, the trend is your friend. It is a cliche because it is true. But how do you objectively define a trend? How do you know when a trend is ending and a new one is beginning? Most people guess. They look at the chart and say, looks like it's going up. That is not good enough. We need a mechanical, undeniable way to define the structure of the market. In Part 5, we are going to master market structure. We will define higher highs and lower lows. We will learn to draw trend lines that actually work, and we will discover the most powerful concept in technical analysis: support and resistance flips. You are going to learn how to identify the invisible floors and ceilings that trap price, and how to position yourself exactly when those barriers break. The candles gave you the letters. Market structure will give you the sentences. Let's learn to read the story. If you threw a handful of sand into the air, you would see chaos. Billions of grains flying in random directions. But if you watched closely, you would notice that despite the chaos, every single grain is obeying the same law: gravity. The market is no different. The candles we discussed in the last section are the grains of sand, chaotic and twitchy on their own. Market structure is gravity. It is the undeniable force that organizes the chaos into a direction. To understand market structure is to understand the geography of money. You would not build a house on a swamp, and you should not buy a currency pair that is structurally collapsing. Yet, thousands of beginners try to do exactly that every day. They see a price falling and think, it's so cheap, I have to buy it. This is called catching a falling knife, and it is the fastest way to lose your fingers. We define the structure of the market using a staircase analogy. This is the foundation of all technical analysis. When the market is in an uptrend, it does not move in a straight line. It moves in waves. Pushes up, then rests, then pushes up again. We call the peak of the push a high, and the bottom of the rest a low. In a healthy uptrend, each peak is higher than the last one. We call this a higher high. More importantly, each resting point is higher than the previous resting point. We call this a higher low. Visualize this. The price of pound sterling to US dollar is at 1.2500. It rallies to 1.2600. That is your high. Pulls back to 1.2550. This is crucial, it did not go back down to 1.2500. It stopped halfway. The buyers stepped in earlier this time. This is a higher low. Then it blasts off past 1.2600 to hit 1.2700. That is a higher high. As long as the market is printing higher highs and higher lows, you only have one job: look for opportunities to buy. You are betting on the staircase going up. A downtrend is the exact opposite. The price falls to a lower low, then rallies briefly to a lower high. This lower high is where the smart money is selling. They are using the temporary rally to get a better price for their short positions. If you buy during a downtrend, you are standing on the train tracks trying to stop a freight train with your bare hands. But the market isn't always trending. About 70% of the time, the market is in consolidation or a range. This is when the price is bouncing between two clear levels, neither making higher highs nor lower lows. It is trapped. This brings us to the two most important words in trading: support and resistance. Imagine a multi-story building. You are on the second floor. The floor beneath your feet is support. It holds you up. If you drop a ball, it hits the floor and bounces back up. The ceiling above your head is resistance. If you throw a ball up, it hits the ceiling and gets rejected back down. Shutterstock. Explore. In the Forex market, these floors and ceilings are not made of concrete. They are made of memory and money. Let's say the euro to US dollar hits the 1.1000 level and drops. It tries again a week later, hits 1.1000, and drops again. This level is now established resistance. Why? Because traders remember. The bears, sellers, know that price was too expensive last time, so they stack massive sell limit orders there. The bulls, buyers, remember they lost money trying to push past it last time, so they take their profits as soon as the price gets close. Support works the same way. If the price bounces off 1.0800 multiple times, it means there is a wall of buy orders sitting there. Institutional whales have decided that 1.0800 is a wholesale price, and they defend it. But here is the secret that separates the amateurs from the pros: the role reversal. Floors and ceilings are not permanent. If you throw a bowling ball at a glass ceiling hard enough, it will shatter. The price will break through. When the price breaks through resistance, the ceiling, it travels to the next level. But often it will come back down to test the level it just broke. Here is the magic moment. The old ceiling often becomes the new floor. Old resistance becomes new support. Why does this happen? Think about the psychology. Imagine you sold euro to US dollar at the 1.1000 resistance, expecting it to drop. Instead, it smashed through to 1.1050. You are now in a losing trade. You are panicking. You pray to the trading gods. Please, just let the price come back to 1.1000 so I can get out at break-even. Simultaneously, there are traders who missed the breakout. They are watching the price at 1.1050 thinking, I wish I had bought at 1.1000. If it ever comes back there, I'm buying. So when the price drops back to 1.1000, two things happen. The losing sellers buy to close their positions, break even, and the new buyers jump in to catch the trend. This double wave of buying pressure turns the old ceiling into a concrete floor. This phenomenon is called the break and retest. It is statistically one of the safest entry methods in trading. You do not chase the breakout, you wait for the retest. Now let's add the final layer to our structure: trend lines. Horizontal levels are great, but markets often move diagonally. A trend line is simply a diagonal support or resistance level. To draw an uptrend line, you connect the higher lows. You need at least 2 points to draw a line, but you need a third point to confirm it. If you see a trend line that has been touched and rejected 3 or 4 times, that line is a self-fulfilling prophecy. Every trader in the world is watching it. When the price touches that trend line for the 5th time, you can expect a reaction. But remember the role reversal rule. If that trend line breaks, the trend is likely over. A broken uptrend line often acts as resistance on the way down. So, how do we combine all of this into a coherent strategy? Step 1. Zoom out to a higher time frame, like the daily or 4-hour. Step 2. Identify the market structure. Are we making higher highs or lower lows? Step 3. Draw your key horizontal support and resistance levels. Look for the obvious levels that stand out. Step 4. Wait for the price to interact with these levels. If we are in an uptrend, we do not buy at the high. We wait for the price to pull back to a support level or a trend line. We want to buy the higher low. This gives us a better price and allows us to use a tighter stop loss. Conversely, in a downtrend, we wait for the price to rally up to resistance. We sell the lower high. This sounds simple, and in theory it is. But in practice, the market is noisy. Sometimes the price will poke through a level just to trigger your stop loss, only to reverse and go in your direction. This is called a fake out. Or sometimes the market looks like it is trending, but it is actually just choppy noise that shreds your account. How do we filter out the bad signals? How do we know if a breakout is real or a trap? How do we confirm that momentum is actually on our side before we risk our hard-earned capital? This is where we introduce the inspectors of the chart, the mathematical formulas that look under the hood of price action. In Part 6, we are going to dive into the world of technical indicators. We will explore the moving average, the RSI, and the MACD. But be warned, most people use these tools completely wrong. They use them as magic 8 balls. We are going to teach you how to use them as confirmation tools that validate your structural analysis. The structure is the map. The indicators are the compass. You need both to survive the wilderness. Imagine walking into a trading floor from the movies. You see screens cluttered with lines, clouds, histograms, and arrows. It looks impressive. It looks like advanced mathematics. It looks like a roadmap to guaranteed riches. But here is the brutal truth. Most of those screens are useless. New traders often fall into the indicator trap. They layer 5 different tools on their chart: a stochastic, a Bollinger Band, 3 moving averages, and an RSI, hoping that if they just find the perfect combination, the chart will light up green and tell them exactly when to buy. This is a fantasy. Indicators are not crystal balls. They are derivatives of price. They are mathematically calculated using past data. By definition, they lag behind the reality of the market. They tell you what has happened, not what will happen. However, when used correctly, they act as a jury. If price action is the suspect on trial, the indicators are the witnesses. You do not convict based on one witness, but if 3 witnesses all say the same thing, your case is solid. We are going to master the 3 most reliable witnesses in the Forex market: the moving average, the RSI, and the MACD. First, let's strip your chart naked and add just one line. The exponential moving average, or EMA. Getty Images. A moving average simply calculates the average price of the last X number of candles and draws a line. A 50-period EMA shows you the average price over the last 50 candles. Why is this useful? Because it smooths out the noise. It cuts through the jagged spikes and shows you the true flow of the river. We prefer the exponential moving average over the simple moving average, SMA, because the EMA gives more weight to recent prices. It reacts faster. In the fast-paced world of Forex, you need speed. The institutional standard is the 200 EMA. This is the line in the sand for the global economy. If the price is above the 200 EMA, the long-term trend is bullish. If it is below, the trend is bearish. Banks and hedge funds watch this line religiously. But for entering trades, we use the EMAs as dynamic support and resistance. Remember the horizontal floors and ceilings we drew in Part 5? Moving averages act as curved moving floors. Imagine the market is in a strong uptrend. The price rallies, then pulls back. It doesn't hit a horizontal level, but it touches the 50 EMA perfectly and bounces. Why? Because thousands of algorithms are programmed to buy at the average price. A powerful strategy is the crossover. This involves 2 EMAs, a fast one like the 9 EMA, and a slow one like the 21 EMA. When the fast line crosses above the slow line, it signals that short-term momentum is shifting to the upside. This is often your get-ready signal. But remember, in a choppy sideways market, moving averages will cross back and forth constantly, giving you false signals. This is why you never use them in isolation. You only use them when market structure confirms a trend. Next, let's look at the RSI, Relative Strength Index. Shutterstock. The RSI is a momentum oscillator. It lives in a separate window at the bottom of your screen and moves between 0 and 100. It measures the speed and change of price movements. Traditionally, traders use it to spot overbought and oversold conditions. The textbook says, if RSI goes above 70, the market is overbought, too expensive, so you should sell. If RSI goes below 30, the market is oversold, too cheap, so you should buy. If you follow this textbook advice blindly, you will lose all your money. Here is the reality. In a strong trending market, the RSI can stay overbought for weeks. If the euro to US dollar is rocketing upwards on good economic news, the RSI will hit 70, then 80, and the price will keep climbing. Selling just because the RSI is at 70 during a strong uptrend is like standing in front of a runaway truck because a sign said, speed limit 30. So how do the pros use RSI? We look for divergence. This is one of the most powerful signals in technical analysis. Divergence happens when the price tells one story, but the momentum tells another. Imagine the price makes a higher high. It pushes up to a new peak. The buyers look strong. But when you look at the RSI, it makes a lower high. It fails to break its previous peak. What does this tell you? It tells you that while the car is still moving forward, the foot has come off the gas pedal. The momentum is dying. This is a bearish divergence. It is a massive warning sign that a reversal is imminent. If you see this happen right at a key resistance level, you have a high probability trade setup. Finally, we have the MACD, Moving Average Convergence Divergence. Shutterstock. Explore. The MACD is the king of momentum. It consists of two moving averages and a histogram, those little bars that go up and down. The histogram shows the distance between the two moving averages. When the histogram bars are growing larger, momentum is increasing. When they start to shrink, momentum is fading. The classic signal here is the MACD crossover, similar to our EMA crossover. But the hidden gem of the MACD is the zero line. When the MACD lines cross from below zero to above zero, it indicates that the market sentiment has shifted from bearish to bullish on a structural level. Now let's synthesize this. Let's build a confluence setup. We never trade based on one signal. We wait for the stars to align. The scenario: you open your chart. You start with Part 5, Market Structure. You see the pound sterling to US dollar is in an uptrend on the 4-hour chart. Higher highs and higher lows. You identify a key support level at 1.2500. The price pulls back and hits 1.2500. Do you buy? Not yet. You need confirmation. You look at your indicators, Part 6. Moving Average. You see the price is also touching the 50 EMA. So you have horizontal support plus dynamic support. That is two barriers holding the price up. RSI, you look at the RSI. It is dipping below 30, oversold. But more importantly, you see hidden bullish divergence. The price made a lower low in the short term, but the RSI made a higher low. The internal pressure is building up. Candlesticks. Finally, you look for the trigger, Part 4. On the 1-hour chart, right at that zone, a bullish pin bar forms. The wick rejects the level. Now you have the full story. Structure says up. Support says up. Moving average says up. RSI says up. Candlestick says up. This is a 5-star trade setup. This is how you tilt the probabilities in your favor. You are not guessing. You are executing a business plan based on evidence. But here is the twist. Even with this perfect setup, even with all 5 stars aligning, you can still lose. Maybe the Bank of England releases a surprise statement 10 minutes later. Maybe a war breaks out. Maybe a massive hedge fund decides to liquidate a position. The market deals in probabilities, not certainties. There is no such thing as a 100% win rate. If you take this perfect trade and it fails, what happens to your account? Do you lose $10? Or do you lose $10,000? Do you survive to trade tomorrow? Or do you blow up your entire savings in one afternoon? Most dummies focus entirely on how to enter the trade. They obsess over the entry signal. The professionals focus entirely on how to exit the trade and how to protect their capital. The difference between a gambler and a trader is not the strategy. It is the math of survival. In Part 7, we are going to tackle the most boring, unsexy, and absolutely critical topic in trading: risk management. I am going to show you the mathematical formula that makes it impossible for you to go broke, even if you lose half of your trades. I am going to teach you about risk-to-reward ratios, and why winning 90% of the time can still leave you poor, while winning only 40% of the time can make you rich. You have learned how to drive the car. Now we need to put on the seatbelt. You cannot afford to miss this. Imagine you are standing at a roulette table in Las Vegas. You watch a man walk up, put his entire life savings on red and spin the wheel. The ball lands on red. He doubles his money instantly. The crowd cheers, he orders champagne, and he feels like a genius. Now ask yourself, is he a professional trader? No, he is a lucky idiot. And the casino loves him. They love him because they know that if he keeps playing, the law of large numbers will eventually destroy him. The casino does not care about a single spin of the wheel. They care about the statistical edge played out over 1 million spins. They know that the odds are slightly tilted in their favor, the house edge. So while they might lose money on Tuesday, they will own the building by the end of the year. To survive in Forex, you must stop thinking like the player and start thinking like the house. You are not here to gamble. You are here to operate a casino where the probabilities are stacked in your favor. This transformation requires 2 non-negotiable tools: risk management and the risk-to-reward ratio. Let's start with the golden rule of survival. The 1% rule. This rule is boring. It is unsexy. It will not make you a millionaire overnight. But it is the only reason professional traders are still in business after 10 years while 90% of retail traders wash out in 90 days. The rule is simple. You never, under any circumstances, risk more than 1% of your account equity on a single trade. Let's play out a scenario to show you why this is mathematical law, not just advice. Imagine two traders, Jack and Jill. Both start with $10,000. Jack is aggressive. He wants to grow his account fast, so he risks 10% of his account on every trade. Jill is conservative. She follows the 1% rule. Both of them hit a bad losing streak. It happens to the best traders in the world. They both lose 5 trades in a row. Jill, risking 1%, is down roughly 5%. Her account is sitting at $9,500. She is annoyed, but she is fine. She can sleep at night. To get back to her starting balance, she only needs to make a profit of roughly 5.3%. It is a small hill to climb. Now look at Jack. He risked 10% per trade. After 5 losses, he has not just lost half his money. Due to the compounding effect of the remaining balance, he is down significantly, but let's keep it simple and say he lost 50% of his starting capital. He is left with $5,000. Now here is the math of death that nobody tells you about. To get back to his original $10,000, Jack does not need to make 50% profit. He needs to make 100% profit on his remaining capital. He has to double his account just to break even. Do you know how hard it is to double an account? It requires aggressive risk-taking, which usually leads to more losses. Jack is now in a doom loop. He enters the market desperate, emotional, and over-leveraged. The market smells his desperation and finishes him off. This is how accounts go to zero. Shutterstock. You must protect your capital like it is your oxygen. If you run out of chips, you cannot play. Now that we have capped your downside, let's talk about the offensive strategy. The risk-to-reward ratio, often written as R. This is the secret weapon that allows you to be wrong more often than you are right and still get rich. Most beginners aim for a high win rate. They want to win 9 out of 10 trades. Soothes their ego. They want to feel smart. But in Forex, you can have a 90% win rate and still go broke. Imagine a scalper who risks $100 to make $10. He wins 9 times in a row. He feels like a god. He has made $90. Then, on the 10th trade, he loses. He loses his $100 risk. He is now down $10 overall, despite winning 90% of the time. This is called picking up pennies in front of a steamroller. Professional traders flip this equation. We aim for a minimum risk-to-reward ratio of 1 to 2, or ideally 1 to 3. This means if I am risking $100 on a trade, I am not getting out of bed unless the potential profit is at least $200 or $300. Let's look at the math of a 1 to 3 strategy. Imagine you take 10 trades. You are having a terrible week. You lose 6 of those trades. You are wrong 60% of the time. You are a failure by academic standards. Let's do the accounting. 6 losses at $100 each equals minus $600. But you had 4 wins. And because you targeted a 1 to 3 ratio, each win brought in $300. 4 wins times $300 equals $1,200. Total profit, $1,200. Total loss, $600. Net profit, plus $600. You lost more times than you won, yet you made a 6% return on your account. This is the magic of asymmetric compounding. You do not need to predict the future perfectly. You just need to ensure that your winners run miles while your losers are cut inches. This brings us to the practical execution. Position sizing. How do you actually ensure you are only risking 1%? Most people think, I'll just trade 1 mini lot every time. That is wrong. Risk is not determined by the lot size alone. It is determined by the distance of your stop loss. Let's go back to market structure. You spot a setup on Euro to US dollar. You place your entry. You look at the chart and see the previous higher low is 20 pips away. That is where your stop loss goes, because if the price breaks that low, your trade idea is invalid. So your risk distance is 20 pips. You want to risk $100, 1% of your $10,000 account. You need to calculate, what lot size makes 20 pips equal $100? In this case, it is roughly 0.5 lots. Now imagine a different trade on pound sterling to Japanese yen. This pair is more volatile. The structure requires a stop loss of 50 pips. You still only want to risk $100. If you use the same 0.5 lots, a 50 pip move would cost you $250. You would be violating your risk rules. So you must reduce your position size. To make 50 pips equal $100, you must trade 0.2 lots. This is the discipline. You adjust your size to fit the risk. You never adjust the risk to fit your greed. You are a sniper, not a machine gunner. You calculate the wind, the distance, and the drop before you ever pull the trigger. But there is a final, hidden benefit to strict risk management that goes beyond the math. It is psychological armor. When you know with absolute certainty that the worst-case scenario for a trade is a loss of 1%, an amount that you can easily make back, you remove the fear. Fear is what causes traders to close winning trades too early. You see a little bit of green, you get scared the market will take it back, so you click close. You bank a tiny profit. Then you watch in horror as the price rockets up exactly where you thought it would go. You missed the big move because you were trading your P&L, profit and loss, not the chart. When your risk is managed, you can detach from the money. You can let the trade breathe. You can let the price swing up and down, knowing that your stop loss is in a logical place and your position size is safe. You become an observer of the market rather than a victim of it. You now have the technical skills. You can read the structure, spot the patterns, and verify with indicators. You now have the survival skills. You understand the 1% rule and the power of risk to reward. You have the car, the map, and the seatbelt. But there is one component we haven't touched. The driver. You. The human brain is wired to fail at trading. We are evolutionarily designed to run from danger, selling too early, and hoard resources, holding losers too long. You can have the perfect strategy and the perfect risk plan, but if you cannot control your own emotions, you will sabotage it all in a moment of madness. In Part 8, we are going to perform open heart surgery on your psychology. We are going to confront the 4 demons of trading: greed, fear, hope, and regret. I am going to show you why revenge trading is the #1 account killer. And I will give you a mental framework used by military personnel to maintain ice-cold focus under fire. The charts are easy. The math is simple. The hardest opponent you will ever face is staring at you in the mirror. Let's go meet him. There is a biological reason why 90% of traders fail, and it has nothing to do with intelligence. It has to do with evolution. For thousands of years, the human brain has evolved to do 2 things: seek pleasure and avoid pain. This survival mechanism kept your ancestors alive in the wild. If they saw a lion, they felt fear and ran. If they found food, they felt greed and hoarded it. But in the financial markets, these exact instincts are not just unhelpful. They are fatal. The market is a counterintuitive environment. To succeed here, you must rewire your brain to do the exact opposite of what it naturally wants to do. You have to run toward the danger when the logic says it is safe, and you have to cut your losses when your heart screams to hold on. Let's introduce the 4 horsemen of the trading apocalypse: greed, fear, hope, and regret. These are not abstract concepts. They are chemical reactions happening in your amygdala. And if you do not recognize them the moment they appear, they will empty your bank account. First, let's talk about greed. Most people think greed is just wanting to make money. That is not greed. That is ambition. Greed in trading manifests as a violation of your own rules because you want more than the market is offering. Imagine you are in a trade. You bought euro to US dollar. Your analysis said the price would go to 1.1050. You set your take profit there. The price rockets up. It hits 1.1040. It is 10 pips away. You are staring at your profit column. It is flashing green. You feel a rush of dopamine. Your brain whispers, "Look how fast it's moving. It's going to smash through 1.1050. It's going to 1.1100. If I close it now, I leave money on the table." So what do? You delete your take profit. You let it ride. 5 minutes later, the price reverses. It drops all the way back down. You go from a $500 profit to a $200 loss. You didn't lose because your analysis was wrong. You were right. You lost because you got greedy. You tried to force the market to give you a bonus check. Second is fear. Fear comes in 2 flavors: the fear of missing out, FOMO, and the fear of loss. FOMO is what makes you buy at the very top of a trend. You see a massive green candle on the chart. You see people on Twitter celebrating. You feel like an idiot for sitting on your hands. So you click buy just to be part of the action. Usually, you are buying the exact liquidity that the professionals are selling into. But the fear of loss is far more damaging. This is the deer in headlights syndrome. You enter a trade. The price immediately goes against you. It is approaching your stop loss. Your plan says, "If it hits this level, I am wrong. I get out." But your brain says, "If I take this loss, the money is gone forever. I will be a loser. But if I just give it a little more room, If I just move the stop loss down 10 pips, maybe it will turn around. So you move the stop, and the price keeps dropping. You move it again. Suddenly, a $50 risk becomes a $500 disaster. You were paralyzed by the fear of accepting a small scratch, so you sustained a fatal wound. Third is hope. In life, hope is a virtue. It keeps us going through hard times. In trading, hope is a plague. I hope it comes back. I hope the news is good. The moment you find yourself using the word hope regarding a trade, you are no longer a trader. You are a gambler praying to a deity that does not care about your position. The market is a cold, unfeeling mechanism of price discovery. It does not know you exist. It does not know you need this money for rent. Hoping that a structural downtrend will reverse because you are long is like hoping gravity will suspend itself because you dropped a vase. When you feel hope, it is usually a sign that you are on the wrong side of the market. The professional response to hope is to close the trade immediately. Fourth is regret. This is the ghost that haunts you after the trading day is over. You look at a chart and see a massive move that you missed. I knew it was going up. I was looking at that chart. I should have bought. This hindsight bias is toxic. It tricks you into thinking you are smarter than you are. It makes you reckless. You start the next day trying to make up for the trade you missed. You force a trade where there is no setup just to prove to yourself that you can catch a move. All of these emotions culminate in the single most destructive behavior in financial history: revenge trading. We have all been there. Starts with a loss. Maybe a stupid loss. You lost $100 on a trade that you shouldn't have taken. You feel angry. You feel like the market stole from you. You want that money back now. Your heart rate spikes. Your palms sweat. You switch to a smaller time frame. You look for anything that moves. You double your position size. If I bet double, I can make it all back in 1 pip. You enter a trade. Goes against you. Now you are down $300. The rage takes over. You go full tilt. You go all in. And 10 minutes later, your account is blown. Revenge trading is the financial equivalent of punching a concrete wall because you stubbed your toe. You are only hurting yourself. So, how do we defeat these demons? We cannot remove the emotions, we are human. But we can build a containment system. We use a military-grade mental framework. The first step is thinking in probabilities. This concept was popularized by the legendary trading psychologist Mark Douglas. You must accept that every single trade has a random outcome. Even the best setup in the world, the one with the perfect support, the perfect indicator, the perfect structure, might still lose. And that is okay. If you flip a coin that is weighted to land on heads 60% of the time, and you flip it once and it lands on tails, do you get angry? Do you feel like a failure? No. You know it's just one flip. You know that if you flip it 100 times, you will win. You must treat your trades like that coin flip. A loss is not a reflection of your worth. It is just the cost of doing business. It is an overhead expense like a restaurant buying food that might spoil. The second step is the employee versus CEO mindset. You have to split your brain into two people. The CEO is the planner. The CEO does the analysis on the weekend or early in the morning. The CEO writes the rules. We only buy at support. We only risk 1%. We never move a stop loss. The employee is the button pusher. The employee shows up when the market opens. The employee is not allowed to think. The employee is not allowed to have opinions. The employee simply executes the orders given by the CEO. When you are in a trade and you feel fear, that is the employee panicking. The CEO needs to step in and say, stick to the plan. The plan accounts for this. This leads to the ultimate practical tool for psychology: the walk-away rule. If you lose 2 trades in a row, you must physically stand up and leave your computer. Go for a walk. Go to the gym. Read a book. Why? Because after 2 losses, your chemical state is compromised. You are primed for revenge. You are not seeing the chart. You are seeing your pain. By walking away, you break the cycle. You reset your dopamine levels. The market will be there tomorrow. Your capital might not be if you stay. We have now covered the mechanics, the analysis, the risk, and the psychology. You are building a complete trader's arsenal. But there is one final piece of the puzzle that turns all of these separate skills into a cohesive daily routine. You cannot just wake up, sit down, and do psychology or do analysis. You need a structured workflow. You need a document that dictates exactly what you do from the moment you wake up to the moment you close your screens. In Part 9, we are going to build your trading plan. This is not a vague goal like, I want to make money. This is a rigid, written contract with yourself. We will create a checklist that you must tick off before you ever click buy. We will define your specific edge, the 1 or 2 setups that you will master while ignoring everything else. Most people treat trading like a hobby and pay for it like a luxury. You are going to treat it like a business and get paid like a professional. Get your pens ready. We are writing your business plan. If you walked into a bank today and asked for $1 million business loan, but you didn't have a business plan, they wouldn't just say no. They would laugh you out of the building. They would ask you, what is your product? Who are your competitors? What are your margins? What is your protocol for a recession? If you couldn't answer these questions with data and documented proof, you are not a business owner. You are a dreamer. Yet, every single day, millions of people deposit their hard-earned savings into a Forex brokerage account without a single page of written planning. They have no strategy for a losing streak, no definition of a high-quality setup, and no rules for when to stop. They treat the most competitive market in the world like a slot machine, and then they wonder why the house always wins. Part 9 is where we separate the gamblers from the professionals. We are going to construct your trading plan. This is not a vague idea floating in your head. This is a physical, written legal contract between you and yourself. It is your constitution. When the market is chaotic and your emotions are spiking, this document is the only thing that will save you. Your trading plan must consist of 4 non-negotiable pillars: your routine, your strategy, your risk protocol, and your review process. Let's start with Pillar 1, the routine. Professional trading is boring. If you are having an adrenaline rush, you are doing it wrong. Your routine should be as predictable as a McDonald's franchise. It starts with the pre-market routine. You do not just open your laptop and click buy. You need a lock-in period. 30 minutes before your trading session begins, you sit down. First, you check the economic calendar, which we discussed in Part 3. Is there a red folder news event today? If the Federal Reserve is speaking at 2 p.m., you write that down. You make a rule. No new trades open between 1:30 p.m. and 2:30 p.m. You have just saved yourself from a volatility spike that destroys amateurs. Next, you perform a top-down analysis. You look at the daily chart to see the big picture trend. Then you look at the 4-hour chart to draw your key support and resistance levels. You are drawing the map before the journey begins. Pillar 2 is the strategy. This is the specific set of criteria that must be met before you risk a single penny. We call this your edge. Most beginners try to trade everything. They see a pattern, they take it. A professional trades only 1 or 2 specific setups that they have mastered. Bruce Lee said, "I fear not the man who has practiced 10,000 kicks once, but I fear the man who has practiced 1 kick 10,000 times." You need to be the person with 1 kick. Your plan should use if-then syntax. For example, if the price approaches a daily support level, and the RSI shows bullish divergence, and a 1-hour hammer candle forms, then I will enter a long position. If the price hits support but there is no hammer candle, you do nothing. If there is a hammer candle but it's not at support, you do nothing. You are a sniper, not a machine gunner. You wait for the target to walk into your crosshairs. If the market doesn't give you your specific setup, you simply close your laptop. A day with no trade is better than a day with a losing trade. Pillar 3 is the risk protocol. We discussed the math in Part 7, but now we must codify it. Your plan must state your hard limits. Rule 1. I will risk 1% per trade. Rule 2. I will aim for a minimum 1 to 2 risk-to-reward ratio. But you need a circuit breaker. This is a rule that stops you from tilting. What happens if you lose 3 trades in a row this morning? Most people try to win it back. Your plan must say, if I lose 3% of my account in a single day, I must stop trading for 24 hours. This rule is not a suggestion. It is a command. It forces you to walk away before you do permanent damage. The market will be there tomorrow. Your capital must be protected today. Pillar 4, and this is the one everyone skips, is the review process, journaling. You cannot improve what you do not measure. Every professional athlete watches tapes of their games to see what they did wrong. You must do the same. You need a trading journal. This can be an Excel sheet or software like Notion or Evernote. For every single trade you take, you must record the date and time, the pair, e.g. euro to US dollar, the setup, e.g. support bounce, the result, win/loss, a screenshot of the chart at the moment of entry, a screenshot of the chart at the moment of exit, your emotional state. That last one is critical. Were you calm, anxious, bored? Over time, this data becomes a goldmine. You might analyze your journal after 3 months and realize, oh my God, 80% of the trades I take on Monday mornings are losers. Or you might realize, I make money on euro to US dollar, but I lose money every time I touch pound sterling to Japanese yen. Without the data, you are just guessing. With the data, you can optimize. You can simply stop trading on Mondays or stop trading pound sterling to Japanese yen, and your profitability will skyrocket instantly without learning a single new strategy. Let's apply this to a case study. Imagine a trader named Mike. Mike wakes up late, grabs his coffee and opens the charts. He sees the price of gold moving up fast. He thinks looks strong, and buys. He risks 5% because he feels good about it. 10 minutes later, news comes out that he didn't know about. Gold crashes. He panics and holds, hoping it comes back. Doesn't. He blows 20% of his account in 1 hour. Mike is a gambler. Now imagine Sarah. Sarah has a plan. She wakes up, checks the news, and sees the gold report is coming out. She decides not to trade gold. She looks at euro to US dollar. She sees it approaching her support level. She waits. The price hits the level. She checks her checklist. Trend is up? Yes. Support holds? Yes. Signal candle? Yes. Risk is 1%. Yes. Risk to reward is 1:3? Yes. She enters the trade. She sets her stop loss and take profit. Then she walks away to walk her dog. She comes back 2 hours later. The trade hit her take profit. She screenshots the chart, pastes it into her journal, writes executed plan perfectly, and closes her day. Sarah is a professional CEO of her own hedge fund. To solidify this, I want you to create a physical pre-flight checklist. Pilots do not rely on memory. Even a pilot with 30 years of experience reads the checklist every time before takeoff. Flaps? Check. Fuel? Check. Instruments? Check. You need a sticky note on your monitor with your checklist. Before you click buy, you literally ask yourself out loud, is this with the trend? Is the stop loss logical? Am I chasing? If the answer to any of those is the wrong one, you abort the mission. This trading plan is your shield. It protects you from the market, but more importantly, it protects you from yourself. It removes the decision-making fatigue. When the pressure is on, you don't have to think, you just have to follow the rules you wrote when you were calm. However, even with the best plan in the world, the journey is not a straight line. You are going to struggle. You are going to have months where you do everything right and still lose money. You are going to doubt yourself. Most people quit right before the breakthrough. They do not understand the trajectory of a trader's career. They expect to be rich in 6 months, and when they aren't, they think the market is a scam. In the final part of this masterclass, part 10, we are going to talk about the roadmap to mastery. I am going to give you a realistic timeline of what your first year, second year, and third year will look like. We are going to discuss the concept of compounding and how small, boring wins turn into generational wealth over a decade. We will wrap everything up and give you the final marching orders to start your career. You have built the machine. Now let's talk about the journey. The finale is next. Here is the cold, hard truth that no one selling a course wants to tell you. The day you open your first live trading account is not the day you start making money. It is the day you start paying your tuition. The market is the most expensive university in the world, and it charges you for every lesson you refuse to learn. Most people come into Forex with a lottery mindset. They look at a $1,000 account and calculate how fast they can turn it into $1 million. They think, if I just double my account every month, I'll be rich by Christmas. Let's look at the reality of that math. If you tried to double your account every month, you would need to take risks so massive that a single losing streak, which is statistically inevitable, would wipe you out completely. This is why the get-rich-quick crowd always goes broke. They are playing a game of Russian roulette with a fully loaded revolver. You are going to play a different game. You are playing the game of the compounding sniper. Let's map out a realistic, professional trajectory for your career over the next 3 years. Shutterstock. Explore. Year 1, the survival phase. Your goal in the first 12 months is not to buy a Ferrari. Your goal is to not lose your money. That sounds underwhelming, but statistically, if you finish your first year with the same amount of money you started with, you are in the top 10% of all retail traders. This year is about data collection. You will make mistakes. You will revenge trade. You will break your rules. But because you are following the risk management protocols from Part 7, these mistakes will be small scratches, not fatal wounds. You are learning to lose without falling apart. You will likely experience the Dunning-Kruger curve. At first, you will have a little luck and think you are a genius. Then the market will humble you. You will crash into the valley of despair. This is where 90% of people quit. They say Forex is a scam and they leave. But you will keep going. You will analyze your journal. You will refine your edge. Year 2, the break-even and consistency phase. Something magical happens around month 18 if you stick with it. The charts stop looking like chaos and start looking like a language you understand. You stop panicking when a trade goes red. You stop celebrating when a trade goes green. You become numb to the money and obsessed with the process. You start to see small, consistent returns. Maybe you make 2% one month, lose 1% the next, then make 3%. You are not rich yet, but you are profitable. You have proven that your edge works. Year 3, the scaling phase. This is where the exponential growth happens. And this brings us to the most powerful concept in finance: compounding. Shutterstock. Albert Einstein reportedly called compound interest the eighth wonder of the world. In Forex, it is the engine of wealth. Let's run a what-if scenario. Imagine you have a $5,000 account. You target a conservative, professional return of 5% per month. To the get-rich-quick guy, 5% sounds pathetic. He wants 100%. But let's look at the math over 10 years. If you simply leave that money in the account and let it compound at 5% monthly, do you know what that $5,000 becomes in 10 years? It becomes over $1.7 million. You didn't add a single penny of extra savings. You just let the math do the work. But you might be thinking, I don't have 10 years to wait, and I don't have $5,000 to start. This used to be the barrier to entry. If you were a good trader with no money, you were stuck. But the industry has changed. We are now in the era of the proprietary trading firm. This is the hack that allows dummies to become whales. A prop firm is a company that funds traders. Here is how it works. You pay a small fee to take an evaluation challenge. For example, you pay $500 to audition for a $100,000 account. They give you a demo account and a set of rules. Make 10% profit without losing 5%. If you have mastered the skills in this masterclass, risk management, technical analysis, psychology, you can pass this challenge. Once you pass, they give you a live account with $100,000 of their capital. You trade it. If you make a profit, you keep roughly 80% of it. If you make 5% on a $100,000 account, that is $5,000 in your pocket. To make that same $5,000 on your own small account, you would have to flip it 10 times over. With a prop firm, you don't need to grow your capital. You just need to scale your skill. However, a warning: prop firms are not charities. They know that most traders fail. They make money on the evaluation fees of people who try to get rich quick and blow the account in 2 days. Do not attempt a prop firm challenge until you have traded a demo account successfully for at least 3 months. This is your final marching order. The demo phase. Do not deposit real money today. Go to a broker. Open a demo account with the same amount of money you plan to deposit later. If you plan to invest $1,000, do not open a $1 million demo account. It creates false confidence. Trade that demo account as if your life depends on it. Apply the market structure. Draw the support and resistance. Wait for the candlestick confirmation. Calculate the 1% risk. Write it in your journal. If after 90 days your demo account is profitable, then and only then do you deposit real funds. This requires patience. It requires swallowing your pride. But remember the pilot analogy. You do not fly a Boeing 747 with passengers on board until you have spent thousands of hours in the flight simulator. You have now completed the deep dive. We have stripped away the marketing fluff and looked at the raw machinery of the Forex market. You know that it is a zero-sum game where institutions hunt retail traders. You know that fundamental analysis tells you what to buy, and technical analysis tells you when to buy. You know that risk management keeps you alive, and psychology determines if you win. You are no longer a dummy. You are an informed market participant. You possess the map. But having the map is not the same as walking the path. The path is lonely. There will be days when you want to smash your monitor. There will be days when you feel like the market is personally attacking you. In those moments, remember this. Every single professional trader you admire, every Wall Street legend, every hedge fund manager, started exactly where you are right now. They stared at a chart they didn't understand. They lost money. They felt stupid. The only difference between them and the loser is that they didn't quit. They treated every loss as data. They adapted. They survived. Forex trading is the ultimate freedom. It is the only profession where you have no boss, no clients, no inventory, and no ceiling on your income. You can make money from a laptop in Tokyo, a cafe in Paris, or your bedroom in Ohio. The market is always open. The opportunity is always there. The education phase is over. The execution phase begins now. Do not binge watch another tutorial. Do not look for another secret strategy. You have enough. Open your charts. Find the trend. Wait for the setup. Manage your risk. This series may be finished, but we are just getting started on this channel. Now that you have the basics, we are going to move into the advanced warfare of trading. In the coming weeks, I will be doing live breakdowns of my own trades, showing you exactly how I apply these concepts in real time with real money on the line. I won't just tell you what to do. I will show you what I do. If you are ready to stop dreaming and start executing, make sure you are subscribed. The market waits for no one. I'll see you on the charts.